In today's video, I'm going to give you the exact guide I wish I had when I bought my first home. Drawing on 8 years as a mortgage broker and over $1 billion in lending conversations across that time. My name is Richard Morgan, I'm a mortgage broker and I've helped hundreds of people buy their first homes. Today's video is everything I've learned over the past 8 years as a broker and over 20 years of buying and selling property as an investor myself. So by the end, my goal is that you'll understand your first purchase better than most people who've already bought one. With that said, let's get into it. Stage 1, start with your goal. Let's start with the part that everybody skips, your goal. Before you look at a single property, you need to know why you're buying. And I don't mean that in a motivational sense. I mean it in a structural sense, because the answer changes what kind of loan makes sense for you. Are you buying to get out of the rental cycle? Are you buying somewhere you'll hold for 15 years? Or are you buying a stepping stone? Something you'll outgrow in 3 to 5 years, and then the equity from it funds the next move. These are completely different files from a lending perspective. For my very first purchase, I was living interstate and decided it was a good opportunity to buy my first home, but not with a view as a long-term owner-occupier, based on something that would be a great long-term hold asset, with the added bonus of being able to take advantage of the first home buyer stamp duty scheme at the time. Here's what most people don't realise. In Australia, the structure of your debt matters as much as the size of it. If your first property grows in value, that equity becomes the deposit for your next one, often with a smaller owner-occupier mortgage than you'd expect. So the question isn't just, can I afford this house? It's, how does this house set me up for the application I'll bring to a lender in 3 years? Most first home buyers never think one move ahead. The ones who do tend to move faster. Which brings me to stage 2. Stage 2, getting financially prepared. When people ask me if it's the right time to buy, they usually want me to comment on the market. I don't, because time in the market is irrelevant to this decision. It's only a good time to buy when you are financially ready. And ready has a specific meaning to a lender that's different from how it feels to you. A bank is looking at 3 things: your deposit, your spending behavior, and the stability of your income. You can feel ready and still fail on the second one. I've seen people with strong incomes get knocked back because their account statement showed a lifestyle the serviceability assessment couldn't support. On the deposit, the number you've heard is 20% plus costs. That's the clean version, but it's often not the real one. You can buy with less than 20% and pay lender's mortgage insurance. You may, however, be eligible for a government guarantee that removes that insurance entirely with as little as a 5% deposit. You might qualify for a waiver based on your profession, or you might use a parental guarantee. We'll get to all of these. The point is, the 20% rule is a default, not the law. And treating it as a law keeps people renting for years longer than they need to. If you're watching this and you've gotten value from this video so far, you're in a position to buy. And if you want a team of experts on your side to make this easy and simple for you, so you don't have to stress, then my team and I at Freedom Funding can help. We deal with this stuff all day. The link's in the description below. Now that you have a clear goal in mind and you are financially prepared to achieve that goal, let's move on to the costs people forget, because this can catch people out. Before you settle on a deposit target, make sure you factor in some of the costs that can feel unexpected. Stamp duty, legal and conveyancing fees, building and pest inspections, rates adjustments at settlement, and building insurance. These aren't small. If you've saved your deposit to the dollar and budgeted nothing for these, you'll be scrambling in the final week. A quick point here when it comes to saving the deposit itself, because there's a lot of noise here. The coffee thing is mostly a distraction. Buying lunch every day isn't what's keeping you out of the market. Major purchases are. A car loan or a financed holiday in the 12 months before you apply does 2 things. It eats your savings, and worse, it shows up as a liability that directly reduces your borrowing capacity. One car loan can cost you far more in borrowing power than the car is actually worth. The mechanical tip that actually helps is separating your savings into an account that you don't touch. So the money has a clear mental barrier before you can spend it. Small friction, big difference over a year. Now that you're ready to go, you understand your goal, you're financially prepared, and you know the costs that most people forget about, let's move on to the next stage of the process, the pre-approval. Once you're in position, you want a pre-approval. And I need to be precise here, because the words get thrown around loosely. A pre-approval is your application assessed by a lender before you've found the property. The reason we do it is to set a firm ceiling on what you can spend so that you're shopping with a real number instead of a hopeful one. But not all pre-approvals are equal. There are weaker versions that are barely more than an estimate. And there's a fully assessed pre-approval where the lender has actually reviewed your documents. The difference matters enormously, and it matters most at auction, which I'll come back to. Now, the next thing that is important to understand is variable versus fixed loans. Now, the loan itself, variable versus fixed. A variable rate moves up and down over time with the market. A fixed rate locks in your rate for a set period, usually between 1 and 5 years. People assume fixed is the smart, safe choice. It's not inherently either. It's just a different tool for a different job. Here's what's actually going on when a bank offers you a fixed rate. They're locking in their margin for that period. That's why fixed rates often look different to variable rates on offer at the same time. And critically, a fixed loan usually won't give you a full offset or a redraw facility. Those features sit on variable products. Offset and redraw are how you reduce the interest you pay by keeping your savings working against the loan. A fixed rate isn't designed for that. It's designed for repayment certainty, not for getting ahead faster. So the real question isn't which rate is lower today, it's do I value certainty or flexibility right now? Some people split it, half fixed, half variable, and most lenders will let you. There's no universally correct answer, only the one that fits your situation. So now you've got your pre-approval, you know your real number. But here's where most first home buyers leave serious money on the table. And I mean tens of thousands of dollars. Because the number a lender gives you isn't fixed. There are government schemes that can lower your deposit, wipe out your mortgage insurance, and lift your purchase ceiling, and almost no one claims all the ones they're entitled to. So let's go through them in the order that actually matters. If you stack these correctly, there are tens of thousands of dollars in value here, but you have to know what you qualify for and the order to claim it. Start with the first home guarantee. This lets eligible buyers purchase with just a 5% deposit and pay no lender's mortgage insurance, because the government guarantees a portion of the loan, giving the lender the security it would otherwise charge you for. It's not just for singles and couples. Friends and siblings buying together can use it too. There are income caps and property price caps, and both change, so you need the current figures for your situation rather than a number from a video. At the time of filming, the main one is the first home buyer deposit scheme, which allow you to purchase with as little as 5% deposit. There are no income caps to eligibility with this one, but each state has a ceiling value to the purchase that you can make, which is up to a maximum 1.5 million in New South Wales. Then there's the first home super saver scheme, which is underutilized because it needs forward planning. In simple terms, you make voluntary contributions to your super, where they're taxed at a lower rate, and then you can later withdraw to a capped amount to put towards your deposit. The mechanics and the cap have specific rules, so this one rewards people who set it up well in advance rather than reaching for it last minute. With FHSS, you can take up to 50k out to contribute towards your deposit, or 15k per financial year. Stamp duty concessions are state by state, and they change regularly. New South Wales and Victoria both offer exemptions and sliding scale discounts up to certain price thresholds, and every other state runs its own version. This is one to check against your specific state and purchase price rather than assume. The last incentive worth mentioning is the first home owner grant. I get asked constantly whether there's a cash payment just for buying a house. The answer is no, not anymore. The grant now applies to new builds only, because the government is trying to incentivize new dwellings, since the core problem is that we simply aren't building enough. Guarantor loans. Now, guarantor loans, because this is an option people understand the least. A parental guarantee works similarly to the first home buyer deposit scheme. So if you qualify for the government scheme, use that first. But if you don't qualify for that scheme, or the property is above the price cap, a parental guarantee can do the same job. Your parents provide additional security against their own property, which gives the lender the comfort it needs to waive lender's mortgage insurance. Here's the part people get wrong. A guarantee does not increase your borrowing capacity. You still have to borrow the full amount. Say you're buying a $1 million property with a $100,000 deposit. You need to borrow $900K, which is a 90% lend, which normally triggers LMI. The parental guarantee secures an extra portion against your parents' property. You still borrow the full $900K, but the lender now has the security to drop the insurance. Depending on the premium, that can save you tens of thousands of dollars. And on lender's mortgage insurance itself, one honest point, LMI isn't evil. Sometimes it's just the cost of getting into the market a year or two earlier than you otherwise could. And if you've exhausted the alternatives, it's often a rational trade rather than a trap. It's a tool. Whether it's the right tool depends on your numbers. Now, emotion and risk, because this is where good financial preparation often gets undone. Buying a home is one of the most emotional purchases you'll ever make, and emotional purchases tend to be expensive ones. Overbidding, ignoring a red flag on a building report, stretching to the top of your borrowing capacity when something tells you not to. The single best defense is to set a maximum purchase price before you inspect anything, and treat that as fixed. Buying well is the art of controlling your variables, and the purchase price is one of those variables that you have the most control over, right up until the moment emotion takes it away from you. There are two mistakes I see far too often, and both are avoidable. Not getting the contract reviewed by a conveyancer, and not getting a building and pest inspection. Skip either of these and you can walk into a problem that costs thousands. When you're working out what to offer, don't anchor to the agent's price guide. Go to the sold listings. Filter for the same suburb and similar properties, and find out what things are actually selling for rather than listen to the agent. If a sale says contact agent, call them and ask. You need to know what the market is genuinely paying, not what the marketing says. Now, a quick specific warning on auctions. Do not bid at auction unless you hold a fully assessed pre-approval. And I mean the fully assessed version, not the weak one. There is no cooling off period at auction and no conditions. When the hammer falls, you've bought it. Have your contract reviewed and your building and pest done beforehand. Set your maximum and stop when you hit it. Then settlement. Your offer's accepted, the property is yours. The settlement period is usually between 30 and 90 days depending on what you and the vendor have agreed. Once the contract's fully signed, it goes to your broker, who runs the valuation and sends it to the lender for the final checks and to issue formal unconditional approval. From there, you'll need to arrange building insurance because the lender will require it before settling, and in some instances, like in Queensland, when you exchange contracts. And touch base with your conveyancer a few days out to confirm you've got the right funds in your account, because there'll almost always be last minute rates adjustments. Don't leave a transfer until the final day and discover it takes 2 days to clear. That's how you miss settlement on a house that you've already won. So if you found this video helpful so far and you want to take action with an expert team on your side, the link's in the description below. We make the process feel simple and easy, drawing on over 8 years of mortgage broking experience. Having a good team on your side is the key to getting this right. So if you're ready, don't hesitate to reach out. Now, before we close this off, let's do a recap. Before you buy, make sure you write down the single number that matters the most, your maximum purchase price. Then work backwards. What deposit does that need? Which schemes can you stack to get there faster? And what's currently sitting on your file, like a car loan or a buy now pay later balance that's quietly reducing what a lender will give you. Most first home buyers start at the property and work back to the money. The ones who do it the other way around tend to buy sooner and buy better. If this gave you a clearer picture of how the borrowing side actually works, that's exactly what this channel's for. I make these because I'd rather you walk into your first purchase knowing the rules than learn them the expensive way like a lot of people do. With that said, thank you for watching and I'll see you in the next one.